And joining us now, Julian Emanuel, Chief Equity Derivatives and Quantitative Strategist at Evercore. Good to have you on, Julian. Given what we've seen in not just the stock market, but on everyone's lips in talking about stocks, even people like you talk about Bitcoin, which is weird. That's different than a couple of years ago where it wasn't ready for prime time crypto, not quite. Now, people look at it as an actual asset class and try to glean things from crypto about the risk trade for equities.
So I think we have to remember that if you look at the history of crypto, and obviously we'll talk about Bitcoin specifically, there have just been these boom-bust sequences really going back over 10 years. And essentially it has been more correlated with periods of volatility and then lack thereof when Bitcoin started rallying. And, looking at it, it really has mirrored that, particularly, again, given the fact that Washington has become much more friendly towards cryptocurrencies. But from our point of view, it is a more volatile asset. It's going to have its ups and downs, and we'll get through this again.
Although some of the blue chip stocks are down more than, I think Disney's back close to 100 again. So there are stocks or assets that get cut in half that are not crypto.
Oh, no, of course. But that's the nature of the stock market. And, a lot of the discomfort that investors have right now is this idea of really what's record concentration. 40% of the S&P 500 is 10 names. But again, part of it, if you look at the long-term history of investing, the indexes tend to be driven by a handful of stocks, and then there are others that do less well.
So there is some fear and loathing out there. You point out, what is the S&P down, though, at this point?
It's really only a shade over 5%. But what we've seen in the markets really would indicate, to your point a moment ago, that the concerns around crypto and credit in general have really permeated. And I would say this, two observations. Number one, when people continue to talk about an AI bubble, it's like the watch pot that never boils. We want to hear more talk about the AI bubble.
Well, we hear it every day today. It's the bonds that the hyperscalers have to float.
So that's the other thing. When equity people start talking about credit, and we've been getting questions nonstop about credit default swaps, and if you look at the broader credit market, it still is telling you that the economy is very solid.
Do you, watching the Fed and the comments that we see, you want to know what someone told me that Susan Collins, the Fed person.
Fed president, yeah.
I didn't confirm it, but I have this person I think might know. Susan Margaret Collins, I think both.
Both the senator
and the Fed
president. Huh.
So that gets confusing.
It's funny because every time they introduce them, and I hear a soundbite if I'm on the radio, if I'm listening on the radio, once I hear the voice, I know.
Right.
They both have distinctive voices.
They do. No more rate cuts. Why? Inflation fears, or the labor market is not in trouble? What is the most important thing? And does it depend on which Fed person you're talking to? There are doves and hawks.
It definitely depends on which Fed person you're talking to. And frankly, this is not Alan Greenspan's Fed anymore. The dissension is out in the open. And
wait, he's gone?
A few years back.
Still around, though. It's awesome.
Right. Yeah. You are likely to have as divided a vote in December as perhaps you've ever seen. We still think there's a greater probability that they do cut. But the biggest issue here is the discomfort with the distance to travel to the 2% inflation goal at the same time that the labor market, when you're clocking 30, 40, 60,000 jobs a month, the question is the new policy towards immigration, does that mean that is the break-even level for employment? We think it is. And so, from our point of view, the economy continues to look good, and inflation, it's taking longer, but it continues to travel towards the lower path. So we think it's okay.
Why did the market freak out last week?
So it's very much, again, going back to this whole question of the perception that the AI trade has become much riskier. What it isn't is earning strength. Okay, so we saw obviously the world's most valuable company report earnings, and then the stock ran and then pulled back in the same day. But if you look at the last couple of years, those earnings reactions have been very choppy, but the direction of travel of that stock and the market itself has been consistently higher.
So if it's not because of earnings, because earnings were strong, if it's not because of the economy, if it's just a change in sentiment, does that mean you think we're headed in for a lot more volatility? Because that sentiment change could continue at any time. People could have these doubts that come up. It doesn't have anything to do with what you're going to see. There's no predictability to it. So
if you look, and again, a lot of questions we get besides the bubble is talk about the bubble in 1999-00. And frankly, that market and this market are both historically expensive. Valuation doesn't end the rally alone, but when valuation is as high as it is now, any little upset tends to get magnified. And actually, if you think about it, where the stress has been the last couple of weeks, contained to certain names in certain spaces where the perception of over leverage exists, but the rest of the market has continued to sort of, grind away, and we think that's the story of 2026.